confident in your trading system or not comfortable with your trading strategy, don't try and force yourself to trade. Number two, if you are going to trade, make sure you keep risk management as a high priority. And then number three, kind of feel like I have to say this. If you guys are using a prop firm account that doesn't allow you to trade news, don't go breaching your accounts, not understanding like the logistics of the account you have. Most swing trading accounts will allow you to trade news, but if you have any regular prop firm account, standard challenge or standard account, you can't trade within 2 minutes of news or something like that. So make sure that you guys don't breach your accounts trying to be a hero. Cool? James said it's Roy's first Christmas of the year. Yes. This is what I live for. I haven't missed a Fed meeting in 2 years. They've all been documented. They've all been done live. And I think the win rate it speaks for itself. I think we're 13 out of 16. So doing pretty good here. All right, let's talk about markets real quick, and then I'll go through my prediction. Actually, I have to do predictions because news drops in 11 minutes, and I have to do that. I told you so. Where I get most of my information is I try to get as much data as I can from different sources. First, I use the CME Fed Watch tool, which is just kind of like I don't know how to describe this simply. It's basically like a measure of probabilities about what the market is betting on, like what the market is predicting for the next Fed meetings. This chart shows the percentage likelihood of rate cuts or rate hikes going into every Fed meeting this year. There's a 95% chance that we see no change today, no cuts or no hikes. In the next Fed meeting, there's a 54% chance that that there's a rate cut in the March meeting. So it's 50-50 right now. So we're going to see how these probabilities play out. But for today, no hikes, no cuts. The market is betting on almost 0% likelihood of any rate hikes in 2024. So we have reached the peak of the tightening cycle. And I think that Jerome Powell is going to try to play off the higher for longer. High interest rates for longer. Everyone's ready for him to start cutting interest rates and get the party started again. But I think he's going to remind the markets that we're not out of the mess just yet. We're going to have to hold these rates. And because the economy is holding stable, there's no reason for them to change policy. So those are my predictions for today's Fed meeting. No change, 95% chance, according to the CME Fed Watch tool, of no changes today, and then a 0% chance of rate hikes. So I think this is still bullish for the markets. This is exactly what the market wanted to see. Now, let's talk about technicals real quick before things kind of get crazy. We're sitting in between two very important ranges. We have this previous range right here, and then we have this current range here. So a bearish scenario would mean that the market is going to retest and then drop back into this area here. That's the bearish scenario. It can't get any easier. The bullish scenario, which is the one that I'm banking on, is going to be the market playing around this area and then recovering back to the very top of the range. Jerome Powell is going to give the market exactly what it's expecting. Guys, I'm decently smart, but not as smart as the people who are analyzing these markets at a high level and have billions of dollars at stake. They're betting on no changes. Everybody else has all the data in front of them. And so I think that Jerome Powell gets on stage, gives the market exactly what they're expecting, and we see a relief bounce on NAS 100. Okay? So those are the predictions for today's meeting. Personally, I am bullish on NAS 100, which is what I will mostly be trading. And let me show you guys some execution options here. Okay, so ideally what I'd like to see is a liquidity grab first to try to fake out the last of the sellers. Typically what happens during news is that you'll see an aggressive move to one direction. You'll see a lot of inexperienced traders start to FOMO into the market and chase the momentum. And then what happens is you'll see a very sharp recovery back up to where all the orders get liquidated. So there's two ways to enter this, which is be very patient. I'm not going to trade until the press conference itself because the markets are going to start to get volatile here. During the press conference, once we start to see price shake out, then I'm going to be entering, ideally it's going to be this 3-drive pattern where you have lows, 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 and then recovery. I'm not going to go into too much detail on education about this stuff, but this is just one of the options I'm looking for. A safer option would be a recovery back above the weekly low, and then a retest. So you have a recovery back above, shows bullish intention back inside the range, and then you have a higher low, which gives you a perfect discounted entry to go to the top of the range. All right. So that's what I'm looking for. If we close below, what is this price here? 17,086 or just 17,050, this whole range right here.
Pasó.
If we close below this, I can see a move all the way to the downside, back down to like the 16,700 area, like the lows of this area. All right. So bullish recovery, or we just see a bearish drop, in which case I'm going to let it go. Any questions, comments, concerns about NAS 100? I just drank half an energy drink, so this live stream is going to go crazy. I'm just going to be honest. I also had a few special guests pulling up. Let me see if I can reach out to them and see where they're at. Okay, give me one sec. We still have 5 minutes until the statement releases. Oh, I gotta send him the link. Okay, good stuff. All right, in case you guys are hopping in late, 95% chance there's no rate cuts, no rate hikes today. It's going to stay the same. Very neutral press conference as to not panic the markets. And so I think this is going to be very straightforward. It's going to be a very straightforward press conference. Expect a fake out, but personally, I'm bullish on this, unless the market knows something that we don't. There's some main factors that everyone's watching to see if the Fed is going to cut rates in March, if they have the leg room to do it. And that's the employment report, that's the inflation report, and that's GDP. So if inflation is coming down and everything that we're doing is working and nothing in the economy is cracking, why would the Fed change? They're going to keep the rates high and they're like, well, it's not crushing the economy, so we might as well keep this going until we crush inflation. The only reason that we would get a very sharp rate cut, which is what everyone wants to see, 2020. You guys remember that, where they cut the rates all the way back down to zero? The party started back up, markets started flying, crypto was going all over the place. Everyone wants that again. The only way that we're going to get sharp rate cuts this year is if we go into a real emergency, either a geopolitical war or we go into a deep recession. So more than likely, we're going to get these little baby rate cuts, 25 basis points, and they're going to be spread out. We came into this year with a market expectation of 7 rate cuts. We're not seeing 7 rate cuts. We're most likely going to see 3 or 4. And so I think the market is already adjusted for that. But the fact that we're still at the end of this tightening cycle and the party is starting to get started, like you can hear the music from the distance of the party, they're getting excited again. And I think that's why markets have been really just bullish for the last few months. Okay. Let me go ahead and get everything cleaned up here just so we can see both screens. And I'll move the video actually to this screen. Beautiful. All right. I think gold will sell and NASDAQ will buy. Okay, let's actually go through the different pairs real quick. Oh, it looks like the dollar is having a lot of trouble with the 103.7 area. I'm personally still bullish on the dollar. I think that dollar demand around the world is only getting higher, especially with a lot of the chaos going on. And so I still expect dollar demand to pick up eventually once there's clarity. When no one knows what the Fed's going to do, it's hard for other central banks to feel confident about putting their money in the United States or just buying dollars in general. So when Jerome Powell gets on stage, gives everybody exactly what they want, I think that relief is going to start to give people more confidence in the United States. It's going to give more confidence in Fed policy, which is how central banks make money. They might trade their own currency for other currencies in the world that have higher yields, and that's how they're able to make a profit. And so if it's more favorable for them to own dollars because of the regulatory clarity and because of the policy clarity, I think that dollar demand is only going to get higher. US 30 absolutely ripped through. We never got the correction that we were waiting on down here at 37,800, but I am seeing a little bit of slowdown. What I would like to see, just because of the Fed meeting, is a correction to the downside and then a recovery back up. And the zone that I'm waiting on is 38,125. So let me actually set alerts here just to make sure that we're not missing this. Okay. See this deeper correction, that'd be great. Damn, I bet a lot of people are shorting right here. You guys know what that means. If you can't see the liquidity, you are the liquidity. Okay. Roy has been saying that he thinks they won't cut them for this month. George, I appreciate you keeping your eye on the ball. Thank you. At least someone's paying attention. What do you guys think? Whether they'll cut rates? Probably not till March or May. Cuban coffee, Red Bull? No, I actually drink half a Bang Energy, and I might drink the other half. Who knows? Things might get a little crazy. All right. I got this old trick. I got this old war trick I learned in Nam. This one. That's sneaky. Okay. All right. So it's 2 p.m. The release should be here. So let's work through this real quick. Here's the statement, first one of the year. All right. I'm just going to skip down. Maintain the target range. So no changes, no changes, no changes, just like we expected. Okay, obviously still committed to their 2% long-term inflation target, which is just kind of their buzzword. 5.25, overnight repos, 5.5% with an operating limit of 500 billion, no major changes. 5.3% for reverse repos and counterparty limit of 160, so no change there. No changes on Treasury redemptions, no changes on MBS, actually slight changes. Okay, exactly what we expected. No change to start the year. So what I'd like to see is the market fill this wick down here just to grab liquidity, and then we can look for a discounted entry below this wick. Luca No Limit said, "What's good, Roy? Fire breakdown. See you at the summit this year easily. The summit this year is going to be one of the most exciting events for traders and is set to be the largest trading event in the world, at least in terms of attendance and in terms of anticipation. It's going to be awesome. Melissa, good to see you. LMA old trick back in Guam. No, I said back in Nam. Yep, market's already dumping for now. Yes, give it a sec. We're going to see this recovery here soon. It's going to break these lows. We're going to finish this 3 drive and get a recovery. If we close below this zone, then I'll let it go and let it reset. They're not trading anymore. I'm in my first trade. Whoa, whoa, whoa. By the way, CA members, my first trade hit break even. the first entry I took. We were in a little bit of profits. Things were looking good. It just hit break even. I'm looking for just one more liquidity grab through and a push back up. Like I said, the Fed just gave the markets exactly what they were expecting. Like this was one of the easiest kind of gimmies that the Fed could have given us. So very straightforward, no changes to the rate. And what people are really watching is the March meeting, because I think everyone already knew what today was going to be like. But there's a 50% chance here, or 54% chance that they cut rates in March. And so it's all about Jerome Powell's press conference and his tone. If his tone says that we're very likely to cut rates, I think we got a good shot here. But if he just tells us, hey, we're going to be data dependent, he's very neutral, then I think the markets are not going to be as excited. If he mentions rate cuts in March, markets are going to fly. I mean, fly straight up. If it's a neutral tone where he says, yeah, it's on the table, but we're still going to be looking at the data in the next 2 months, then I think that we're going to see some bullish movement, but it's not going to be as aggressive. So the very aggressive scenario is him confirming in plain English that they're cutting rates in March. If he says no rate cuts in March and he says that confidently, he just tells them, look, take that off the table, markets are going to crash. But that's the only scenario that I can see where we would get a very bearish market expectation. He said, watch the 3-month time frame. Yeah, all right, thanks, bro. Fucking, you know what I'm saying? We got fucking Warren Buffett over here. Thank you. All right, that was rude. But ain't nobody watching the 3-month time frame right now, bro. This is day trading. I got half a mind to re-enter right now off this rejection. See a beautiful inverse head and shoulders right here. It had to be a pretty wide stop though to account for any of the wicks during the news. So there's two ways to trade news. And obviously, I did a reminder at the very beginning of this, and I'll just do this reminder again in case you showed up late. No one is obligated to trade during high-risk news events. And so if you guys are traders and you're thinking to yourself, okay, I got to find a trade or I got to do this and that. No, you don't. If you stay out of news, you can learn so much more than trying to force a trade. By the way, I'm going to enter a position here, guys. It's going to be very small. I'm going to cut my position size down by pretty good amount. I'm going to probably do half of the normal size or less than half of the normal size I do, because what I want is to save ammo. I don't want to put, all my eggs in one basket right here, and then the market dips down lower to a better price, and then all of a sudden I have no more ammo to take advantage of the real price movement. So what I do is if you're going to, whatever your daily risk is or whatever your risk is per trade, let's say it's $1,000 or let's say it's 500. All right. You can put, let's say 150 risk here. That still leaves you with 350 for max risk. So if this thing continues to go down and you can get a better entry, you still have some ammo to take advantage and then make your money back on that original loss. The other way is just to be patient. If you get that dip down, you can just enter that. If you don't get the dip down, just let it go and then let the market reset for tomorrow. So number one, you're not obligated to trade. Number two, if you insist on trading, make sure you understand proper risk management and make sure that you're not putting all your eggs into one entry, because markets do tend to kind of throw a temper tantrum and shake out before they move, especially on news days. Okay. I haven't entered yet, just as a side note. I'm giving this thing a quick second here. See if it wants to keep breaking down or if it's respecting that zone. Give it 1 second. Yeah, it looks like pretty fair rejections here. All right, I'm in a small position here at 17,240 for longs. Make sure that you guys are keeping that risk management in check to give yourself, like, save some ammo on the sidelines because we might get a better entry during the press conference. Let me clean this up just a little bit. This trading stream is not to be construed as investment advice. Please do your own research and make sure you guys are keeping risk management as a high priority. Trading Forex involves risk to your account. So make sure that you guys are being responsible and trading and not gambling. All right. Gold, I do see a little dip down on gold here. It depends on what the dollar does, obviously. We had a short position here at 2046. This was on Monday, I believe. Pretty nice push down to 2030. Market is already up here and then rejecting again. If we break above 2046, there's a good chance that gold continues to the upside. I don't know. I could see this thing coming down still. 2046. I could see this thing coming down to 1998. But we'll see. I'm not a gold trader, so take that with a grain of salt. I day trade NAS 100. That's my main focus, and so that's what I'm going to be watching for today. Oh, US 30 is coming down for that pullback. So I see a US 30 pullback to 20 or 38 130, and then longs from there. USD JPY, it's way too high into the trend. So the original entries were all the way down here. And so we're very late into the trend. What I would personally like to see is the market come back for a pullback, much needed, before we continue. Here's the thing about USD JPY. I'll give you guys a little trick. You guys can use this one. You guys can take this one to the bank. On the higher time frames, if you have your fibs drawn correctly, if the market is respecting support at the 38.2 and it continues to form support here, this becomes higher time frame support. There's other pairs where this doesn't necessarily apply. I've seen this on the higher time frames on UJ, where if the market finally breaks above that 38.2 and it just keeps sitting, keeps sitting, keeps sitting, this is going to become the new floor, and you can get a push to the upside. I'm personally bullish on the dollar, and so I have no reason to believe that UJ will make a massive drop, but it is very late in that trend. So for me, I'm just going to let this one go. If we come back and the daily closure is above the 38.2, this 147.1 price right here, then I'll look for some long positions. Here's a different view on NASDAQ. Daily view, it's clean. It looks like there's a lot of room to the downside. So I'm not discounting the fact that markets could be in for a pretty deep pullback, but I just don't see any reason fundamentally for the markets to drop. I think that the Fed is going to give the markets exactly what they want, and I just don't see any reason not to see that relief bounce. So my man, quarterly trading, chill, chill. I'll let that one fly. That was rude. Bitcoin still pushing to the upside. That's beautiful. Yeah, the dollar looks like it just already rejected and pushed back up. So Euro USD, I think we can continue to see this drop. I think UJ is going to go back bullish. I think gold is going to end up seeing a nice drop, even though I think I deleted it off my watch list by accident. There it is. Okay, sold gold the same level from yesterday, secured the bag. Diego, that's what I'm talking about. Good stuff. Waiting for gold to come down to 20, 36, 37 and bounce and reject, and then you'll buy. There you go. Using 1 hour for entry? Yes. Maybe 30 minutes too. All right, we're about 18 minutes away from the press conference. Let me know if you guys have any questions real quick. If not, we can go through a few more reminders here before the news gets started. Drop a like if you guys have found anything valuable in this live stream. And of course, hit a subscribe if you guys want to see this every morning where we live stream New York Market Open and I live trade NASDAQ 100. Talking about Raja? He canceled his live when both entries. I don't even know. Do you use seasonality? When I'm cooking dinner, I guess. I don't know, bro. What are we talking about right now? All right, that was a joke, Will. That was a poor joke. Gotta head out. Jacques, I'm gonna catch you later. He said, let's go, Naz. Two-step. Let's not celebrate too soon, brother. Let's not celebrate too soon. It's only been a few points. We just had a little pop-up. This thing could still come down to fill, so just keep your expectations limited, everybody. When you're trading, it's really easy to get caught up in like the relief of, damn, I'm out of drawdown. I'm finally back in profits. Okay, this could be it. Keep your expectation. Like for me, I'm an optimist in real life, but I'm kind of a pessimist when it comes to my trading. So I assume the trades are going to lose only because it helps my psychology. Here's what I mean. If I hopped off the stream right now and I was to put away my phone, I would understand exactly how many dollars I was risking, what percentage of my account I'm risking, and I would accept that risk. So when I close my computer or put down my phone, I'm not going to come back with this heart attack of like, all right, let me see what's going to happen when I open up MT4. No, like you know that the only thing that can happen is you're going to come back to a negative 800 or negative $1,200 loss, or you're going to come back and then you're going to be relieved that it's going your way. Now, when it's the other way around and you're like, okay, no, this trade's going to play out, and you come back and you open up the phone, it's negative, you're going to be disappointed, which might lead to trading errors. So for me, I'm just kind of like I try to keep realistic expectations by understanding that every trade I take could be a loser, and then setting up my risk management in a way to where I can accept that loss. So if I'm risking $500, I know this is the 500 I'm risking, and I have accepted that loss. Said Goya seasoning. All right. All right. Two bad jokes in one stream. Sam, I'm just getting started and I'm just getting warmed up. 223 people watching the stream. Appreciate you guys spending the FOMC Fed meeting with us. We're going to get started in 15 minutes once Jerome Powell hits the stage. And I had a few special guests, a few economists that were supposed to step on. However, they're at a hedge fund conference here in Miami, so they might not be available to get on with us right now. Hopefully, we can see one or two guests get on here and give us their take, what they think is going to happen. Let me just check my messages. Nice. Seasonal tendencies, as in selling in summer months, buying after October, etc. So yeah, there's definitely seasonality. So if you look at how institutions make money or buy and sell assets during the year, they typically try to lock in losers late in the year so they can offset their taxes. They typically like to rebalance portfolios early in the year and try to buy into things that they think have potential, sell out of losers, etc. So there's definitely seasonality. When it comes to trading NASDAQ, I think the most important is earnings. And so the earnings schedule in the year is very important. And then Fed liquidity. So when it comes to trading stock market indices, the biggest correlation I've seen is between stock market performance and Fed liquidity. So the more money that's in the system, the better that stocks do. So when it comes to schedule, that's really the most important thing for me. There's 8 Fed meetings in a year. Right now, we're reaching the end of a tightening cycle. And so how fast we cut rates and how excited the market gets, that's what's going to determine the trend and the velocity of NAS 100. So when I put a lot of emphasis on Fed meetings, that's why. Because Fed liquidity is the single greatest corollary to stock market performance. Got over a 90% correlation. So that's what I think, Fran. Plus, you also have to realize the difference in stocks. So cyclical stocks typically follow the greater business cycle. But when you have like more speculative stocks like technology, they're really following a liquidity cycle, not so much a traditional business cycle or economic cycle. It's like, yeah. Every trade I take, I assume it's gone already. If the market wants to give it back and then some, it's a bonus. Yeah. Like I don't, it kind of suck. Like it feels weird to say, yeah, I assume the trade's going to lose because I know that kind of comes off wrong to some people, but it's a psychological trick because it's all about the distance between expectation and reality. That's what leads to a lot of emotional trading. You expect something, the distance between your expectation and the reality is called disappointment. And the greater this disappointment, the greater the emotional response, and then traders tend to do dumb stuff. So to avoid that gap, in called disappointment, what you do is you limit your expectations or you set your expectations very low so that when the market over delivers on a consistent basis, you are relieved as opposed to disappointed. Can you explain again Fed cuts means strength or weakness for the dollar? Well, just as a reminder, there's no cuts today, but Fed cuts in general make it more attractive to borrow in the United States. And it's going to be there's a lot of factors that impact dollar demand right now. It's not just Fed policy. When bond yields are higher, typically what people do is they'll buy US Treasury bonds, and you typically do that in dollars. A lot of the debt that America issues to foreign governments is dollar denominated. Most of the transactions in the world, consumer transactions, or sorry, not consumer, commercial transactions are settled in US dollars, and the majority of oil trade in the world is settled in US dollars. Europe's economy is weakening, and the euro dollar market is just as big as the market here in America. So if you add up all of the different factors that lead to central banks needing dollars in their bank accounts, in their central bank accounts, I think the dollar demand is going to continue to climb. And then as there's more geopolitical chaos, people don't necessarily want to own debt in some of these other central banks, and they're going to want to come to the United States. So all these factors impact dollar demand. And then you have to realize that demand for currencies is relative. So it's not like, is the dollar the best currency? It's, is the dollar better than all the other ones right now? And if the answer is yes, that's why you can see the dollar going bullish and stocks going bullish like we just saw. Because people want to be in America. It's not just about owning one asset. They want bonds and they want stocks and they want dollars. You guys see where this is going? What about BRICS and how will that affect the US dollar? BRICS is a joke. I'm going to be real. I wouldn't say it's a joke because there's a genuine threat of dollar dominance being challenged. But if we look at those countries, and if we look at who's leading the charge, i.e. China, you can't just shift away from the dollar. I just explained how much debt there is out there in US dollars, the US military capacity to protect the dollar, the petrodollar system, which gives the dollar its value, it's protected by US military interest. You cannot displace that. I'll give you guys a side story before this thing starts. I used to work on Capitol Hill. I worked for a few congressmen, and I was in there here. I was in this hearing one time, and they were talking about building a new rail system because one of the congressmen just got back from Japan, and they had this like magnetic levitation rail, 200 miles an hour bullet train that was so advanced it connected the entire country and made intercity travel possible. Okay, cool stuff. They asked, why can't we fix that in the United States? Like, why can't we do the same thing? And somebody explained the costs. The cost of, if you wanted to raise the speed limits on one highway from 40 to 45 or from 60 to 65, it would cost so many billions and billions of dollars. It would back up traffic for so long, it would destroy economies. So that's why they just keep the speed limits the way they are, or they just do it in chunks. Doing the same thing, if you try to dismantle a currency system and you have to go to all of these developing countries that don't really have you don't have 6 months to be able to like withstand the heat of switching over to a new currency because you're going to have to dismantle your whole economy and start it over from scratch. Big countries can afford that, small countries can't. You can't get 150 countries to just all of a sudden destroy their economies for the sake of switching over to a currency that has no tested market value. You guys get where I'm going with this? The cost of transition is too high. China can't lead the charge because they have too many demographic problems. They're dealing with a real estate crisis, like their version of the 2008 financial crisis right now. This whole idea of China overtaking the US, I think, has gone out the window. Maybe in terms of GDP, just because of the size of their production capacity, but not in terms of living standards or anything else. Where can I learn about all of this? On this stream. Booty. What? Was acting like I'm not dropping game right now. He's like, oh yeah, thanks for all this game. Where do I learn about this? By getting a pen and paper. It's like, no, let me chill. All right, 7 minutes, y'all. 7 minutes until Jerome Powell hits the stage. It's a perfect time for a reminder. I was just being a dickhead, but you get what I mean. Just a quick reminder, the next and final masterclass relating to the NAS 100 trading strategy that we trade live on these YouTube streams every day is going to be February 2nd. That's in 2 days. Make sure you guys grab your seats by heading to the link in the description if you guys want to learn a true, tried, and tested NAS 100 day trading strategy. You guys ever heard of divergence before? It's when you have price going one way, but then you have volume going the other way. Buying volume usually wins. Said you should put the 200 EMA. It'll help you understand where the 4 hour is heading. 16,870. I like the 200 EMA. Actually, no, wait. I already have the 200 EMA right here. It's possible. I'd say like 16,900 area. 870 is very fucking accurate if it does make it down here. But I just don't see why it would, because if the Fed gives us exactly what we're looking for and the market has already shaken off the liquidity, I think that what we can see is one final push here to get the last of the sellers to really pile on, and then we have this recovery. I just can't really see why we would have such a deep correction, especially if there's no emergencies and there's no real negative news. Then again, anything is possible in markets, and so I'm not going to say it's not possible. This is definitely a target area, but I just personally am banking on the market making a flash, like a flash drop to take out a lot of liquidity and then push back bullish. Time will tell, people. Time will tell. We got 4 minutes left. What time frames do you use divergence? I struggle with jumping to fast-based divergence. It depends. If you're taking an entry or you're looking at a 1 hour structure or 1 hour model, then you can use the 1 hour divergence. But if you're looking at a daily structure, for example, like this, you can't really rely on 1 hour divergence or smaller time frame divergence. So whatever time frame you're looking to trade, it makes sense to look at divergence on that time frame only for confirmation. Indeed, Chris says yes. Got a full house here on Zoom today. Chart Addicts VIP members here sitting on Zoom. Let me know if you guys have any questions. Can you explain price efficiency? No, not relevant. Can you swing trade with fundamentals? Technically, yes, but I'm not a big swing trader except for occasionally I'll swing trade currencies. But I've been so focused on day trading. I'll show you guys an example. Is I missed this USD JPY entry that I was waiting on. I was waiting on an entry down here at 139.6. And so if, I do swing trade currencies, but the two swing trades that I was waiting on, which is Euro USD shorts and USD JPY longs, I did miss. Just to be honest, this one as well. I had it all marked off, perfect levels, everything was perfect, but didn't get in time. Waited for a pullback, waited for like a double top rejection. Once we had the first sell-off, never got it. We just had this liquidation here. So I do swing trade, but not for NASDAQ. What I do for NASDAQ is I day trade. I take the majority of the position off the table. I take my partial profits, and I leave a small running position in the direction of the trend. So I'm not necessarily swing trading it to a predetermined price, but instead what I'm doing is just holding it in the direction of the trend just to see what's going to happen. I'm overall bullish on NASDAQ in the long term. I don't have a price target except for 20,000, which is years away. So really, I'm just buying dips in the market and trading in the direction of the trend. Guys, we got a very good friend of mine, Ken Chigbo, is about to join us from the UK or from Dubai. I'm not really sure where he's at right now. He was a market analyst for many, many years. He's been doing fundamental analysis for over a decade. And I'd love to get his take on this Fed meeting predictions before this thing kicks off, even though we got about 2 minutes in. Ken, how are you doing, my friend?
Hey Roy, how are you?
Living the dream. We got another Fed meeting. It's the first one of the year. You know, I'm excited.
Yeah,
So
man.
we already had the news drop, no rate changes, but you know, everyone's attention is on the March meeting. Ken, what do you think is going on here?
Definitely. Well, first things first, markets largely got carried away with the December meeting, right? At the end of the day, all the FOMC did in the December meeting was really indicate to or communicate to the markets that, look, we're unlikely to be hiking again. That's just not going to happen. Our next move is more likely to be an interest rate cut. Now, markets, obviously being markets, run with anything, and I think they got overexcited. So if we look at this initial statement that's attached to the decision, for me, it has a bit more of a hawkish tone to it, a little bit of a pushback. You know, they noted that the economic activity has been expanded at a solid pace, and we've seen that. I've continued to preach that, and I'm sure you've seen it, Roy. Like, the data from the United States remains solid. Like, you tell me where we're seeing a massive slowdown in the United States. We're not seeing a massive slowdown to warrant the hikes in which the markets got carried away with pricing in. Obviously, Powell's due to speak up in a moment. But one of the key things that we'll keep an eye on, because they said that they did not expect it to be appropriate to reduce their target range, i.e. cut interest rates, until they've gained greater confidence that inflation is moving sustainably towards their 2% target. Now, what the key thing for me at this conference now, when we hear Powell, is he's likely going to be questioned on what does that greater confidence mean? Try and give us a time frame of what you of when you're predicting for that greater confidence to come into play.
My expectation
for us
is
to
that
see
March
those.
is too soon. And I didn't mean to cut you off.
It's too soon.
He's about to hit the stage. So I think that he's going to start to hint. I think he's going to be very neutral today. He doesn't want to split the markets. He's going to leave the door open for a March rate cut. But I don't think that there's enough data between now and then to justify that cut. We might push it off until the May meeting.
Agreed. And just quickly, one thing I'd like to say is still 47%. So this is the probability is great. So we're going to have decent volatility anyway, you know, so it's not heavily skewed to one side. I think this is great. It's a good opportunity for the dollar bulls, I think, in my opinion.
I agree 100%, which might not be good for the NASDAQ long trades, but
No.
we do have the dollar bulls, and dollar targets are definitely looking good here. 104.5 and then 105.5. Tons of room to the upside.
Definitely. Well, he may correct the stock market bulls potentially here. I mean, we're already seeing pullbacks at the moment, aren't we? So we'll see how deep that goes.
That we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a
Yo, Roy, I don't think we can hear it.
Roy, just as a heads up, I think you've muted the press conference. Powell speaking. Just FYI, the guys can't hear it.
165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years. And immigration has returned to pre-pandemic levels.
Exactly what you were saying, Ken. A U.S. economy, very resilient, very strong.
Vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal.
Ken, word for
Longer-term
word.
inflation expectations appear
Yeah.
as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points, and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year.
Come on. If that doesn't
But the
move
economy has
NASDAQ,
surprised
I don't know what will.
forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate.
Higher for longer.
Yeah.
As market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%.
It's pretty hawkish stuff right now.
Reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%.
Okay, we need to understand what that greater confidence means, how to quantify that.
They'll ask them in the Q&A.
Yeah.
Goal, and to keeping longer term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Here we go.
Now the fun begins.
Sheena Smiler from the New York Times. Thanks for taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is
The first question.
Yeah, it had to be.
Gain that confidence. And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6 month data isn't low enough. It is. It's just a question.
I'm going to protect the NASDAQ trade
with confidence that we're moving sustainably down to 2%. That's really what we're thinking about. In terms of,
I'm going to secure some partial profits
growth,
as well.
We've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter.
Nice. Nice.
And yet we've had a very strong labor market and we've had inflation coming down. So I think whereas a year ago, we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point, we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry if I could just follow up,
If you guys took the trade, just shout out your entries in the chat real quick.
make sure that it's a true signal. Is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to a sustainable path down to 2% inflation.
Nick.
Nick Timros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years.
I think stocks liked that little spiel from Powell because he just acknowledged that, you know, that inflation is good. It is moving in the right direction, but he just wants more confidence that it's going to continue before they start pushing for cuts, basically. But stocks are liking that, seems.
3 months.
I think the drop that we saw recently was the market pricing in the likelihood of no cuts in March. They're like, okay, all right, as long as they come in May, we're fine.
As you know.
Yeah, exactly. Agreed.
I'm more concerned with the end of the tightening cycle.
Committee
like we're finally done.
Will be appropriate to
they can hear the music through the door in the background of the party, and they can already start to.
That you say,
you know, they're already starting to get excited.
This coming down. Growth is strong. The labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back to 2%, so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or experience. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book and they're in all the materials that we look at. But you know, I don't think we've ever been at a place where we were setting policy by them. They're depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is implicitly is so in theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated.
Wow.
What's the step down from
Talk
there?
about a daily rejection.
Yeah, I don't know that we worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, and it's still well above core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And the case is likely that it will continue to come down. So that's where it is. But we're wanting to see more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates?
Yes. So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening in certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things, would argue for moving later. In the base case, though, where the economy is healthy and we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down. That's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement. There's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. There was no proposal to cut rates. Some people did talk about their view of the rate path. I would point you to the SEP as good evidence of where people are, although it is one cycle later. So, we're not at a place of really working out those kinds of details because we weren't actively considering, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including
Rent costs.
Yeah. Well, so we're not, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You point to rents. So of course, we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation. So the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time, but it may well have some more time to run. The supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that. And I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important. And that is, a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that other set of factors is really different from other cycles, and has brought that, working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest sensitive parts of the economy, as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, that it's not something you can identify with any precision, but a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract a sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate that neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So So I think the question is when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you, sorry.
So just to kind of chime in here, guys, he's not saying anything that we didn't expect. Data dependent, keyword. Still too early to tell if we've made it out of this. The thing that I really like from him is the 12-month kind of outlook. So now instead of looking at these monthly prints and expecting massive price movements, I think he's going to try to smooth that out by having a longer term approach and telling people to look at the longer term or the annualized data as opposed to just the monthly prints.
What they were pre-pandemic, even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market by many measures.
Also, yes, I did re-enter on that retest back down in case you guys saw.
One or more of them. So I think, job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens. It's probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
I think the labor market I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to what is still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And, one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk. The risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here and why we're not rushing. So I think both of those are risks, but I think the more likely risk.
I'll always be impressed by Jerome Powell's ability to have a foot in the door and a foot out the door at every moment. Yeah. This guy belongs in politics.
Where
it's so true.
See, will inflation have dipped and then come?
Well, not necessarily. Bro, it was a yes or no question.
Right. We don't have it won't repeat themselves. We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor. Is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
As it looks like sellers want to take back over on the smaller timeframes. We're seeing tons of rejection at the 17,300 zone, which we needed to break. If we can't break above that level, prices might be headed down for another grab before we push. So keep that in mind. My stops are all in break even, so trades are protected. And now it's just a patience game till the end of this meeting.
Mentioned below 2% inflation for on a 3-month basis. Core PCE has been running at 1.5%. And there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target.
Okay,
How do
sure.
you see that?
So how to your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years. So it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target is not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking
All right,
for
my man Roy, I'm gonna have to shoot now, bro.
once.
Good to jump
And
on.
I appreciate you a ton. Thanks for stopping
No,
by.
all blessed, bro. Take it easy.
For sure. Appreciate you stopping by.
Or two of lower, and we have that now of inflation that's annualized at a
You gotta go
lower
check
level.
these trades.
That wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question which we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it in your view a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully.
My break even just hit.
When to begin to dial back the restrictive stance that we have in place. So
if we break
take
back
that
above
to
the 730
the
or
current
236, I'll enter another position.
context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that. But that's to be seen. So I wouldn't call, when you ask me about in the near term, I'm hearing that as March. I would say, I don't think that's probably not the most likely case or what we would call the base case.
So they just said no rate cuts in March.
Is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook,
All right.
the balance of risks.
I think Sellers going to win this one.
Decisions based
No
on
rate cuts in March. He just said it.
It could wind up, we'll have another SEP at the March meeting, and people will write down what they think, but
Still
in the
made
end,
money, though.
it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, it would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
I also want to give a reminder to traders, do not give back your profits trying to chase or make big money just because the trade didn't fly. Protect your wins, walk away. A great day is where we traded news, things didn't exactly fly, but we still had a 100-point move here. Bag your wins, don't give your money back at all costs. Protect your funds.
Growth has been very strong. How much of those numbers do you attribute to productivity? And do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about? Or do you think that productivity growth will fade over time?
So this is a really interesting question. And I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force and activity returning and supply chains getting fixed.
Right. So would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity?
That's
right
one
now?
way to look at it. Yeah.
Nancy.
Hi, Chair Powell, Nancy Marshall Genser with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important.
There's gold.
People's lives, but they're not.
There's gold. Damn.
Things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built
Did
up
anyone
set
take the
of
gold trade
cities
or no?
and people are moving further and further out. So there hasn't been enough housing built. And these are not things that we have any tools to address.
There's
But,
Euro
where
USD,
it
which means the
comes into
DXY
play
must be jumping.
specifically
There it
in our
is.
work
Magnets don't
is
lie.
Inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI
DXY bullish
calculation or the PCE calculation, the one we look at.
Bitcoin.
And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that the job Congress has given us is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly mostly for people
I'm taking one last entry on NAS. I know it's a little bit risky, so I'm going in low risk and I'm not giving back my profits. I'm only risking a very small percentage of the money I've already made. Small percentage
Right away,
of what I've already made.
Middle class.
And I'm getting back into this
Some
for the rejection
scope
back up.
to absorb higher costs. So we have to it's our job. It's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions of balance sheet issues at our next meeting in March. So those questions are all coming into scope now, and
this is not one of the highest probability trades, guys. So don't sit there and put the same weight on this trade as you would on the original entry that we took. We're at an 88.6 here temporarily, so I just want to see the wick back above the 236. Just keep in mind that risk management is the highest priority, especially this late into the press conference.
Reducing rates, but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet run off to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
This is a good question.
I'm not in a position to put a number on it. I'm just going to say, and it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction. And we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from Market Watch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that.
Ouch.
Do you want another term? You've had on the Fed.
Hell no, he doesn't. Who would want this job?
It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're all of us very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
as you mentioned, core PCE has been running at 1.9% over the past 6 months. And you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. Then you referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good at inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more perhaps than you already have factored in?
I think if we came to that the 6-month inflation numbers, which are very close to 2, were in PCE world. If we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Davis, Agence France-Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case. And we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But it is a fact that we have seen a meaningful increase.
I think sellers are going to end up winning this one, guys. Haven't seen a meaningful rejection here yet, and I think sellers are going to end up driving price down. So, in case you're wondering if you should get in or not, I'm getting ready to wind out of this trade soon. If I just see one rejection up, I'm going to protect the trade, and then just let the rest of this thing ride.
Leaders and stakeholders in person to learn more about the economy in real time, given that some data are subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes, I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy. And I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone, that in all their districts, they're talking to, not just the nonprofit community, they have arms into all of that. And so when they come back, that's
Real quick, if you guys are watching, you still awake? I know it's boring. I'm going to sum up exactly what he's saying, but just stay awake here for a little bit. I know Fed meetings kind of tend to drag on, but he's about to wrap up here in a second. So bear with us here.
they will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from like their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, it was more. There was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Go to Jeff Cox for the last question.
Last question.
Thank you, sir. Jeff Cox.
That's the last one.
Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why.
I just cut my risk on that trade, cut the position size in half. I kind of have I won't say a bad feeling about it, but I do have a bad feeling about it. So just for risk management purposes, I did cut my position size even lower than it already was. Just in case this thing doesn't go my way, I'm not going to give back a big chunk of the profits I made. If we see a rebound, it'll make up for whatever I closed.
A price stability mandate. And those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
Talk about a press conference. What just happened is the real question. So let's talk trading real quick, and then we can get to the rest. So first trade was an absolute banger. I think it was a 1-to-1 R&R. We got up to the first take profit level, even broke through, but we weren't able to close above, which is obviously, as you guys know, is a major factor for what we look for that continuation of that trend. So what I did was TGIP, you mentioned it. You're going to have to give me your real name just so I can call you by your real name. But I did end up taking that wave 3 that I was looking for, in case you guys are a little confused on that. Just for the masterclass folks, you guys can see this is phase 1. Then we had phase 2 broke up first and then cleared liquidity from the London lows. And then now I'm expecting a recovery back above these highs here. And so the entry was right at this low. Price is still playing around. And so I'm going to give this thing a second just to see if it'll reject. With no rejections, the market is going to keep selling off. But if we have this rejection, I'm confident we can make it back up to the 17,352. And that's where, we can close more partials on this trade. So overall, 2 positions taken, profits were made on both. I did secure partial profits on the second one, and now we just let it ride. Overall, markets played out exactly as expected. We had a bullish dollar. Shout out to Ken for stopping by and giving us his take on what he sees with currencies. And then we had that gold sell-off, beautiful rejection at 2046. There was a little bit of drawdown, obviously, but that retest of the 2046 zone and sell-off was beautiful. And personally, I don't trade gold, but I do expect this thing to continue to the downside, down to the 1998 level. So that's my target for gold in the medium term. US 30 came down very close to the intended target that we had, which is 38,100, but I have a feeling that we could break just a little bit lower, back down to the 37,800s. This is a little bit of a deep retracement. Like the market would have to really continue selling off through the rest of this session and tomorrow. Otherwise, it's just going to close back above this support and then just play around here. So 37,800. You guys might see me take longs here later this week if we do make it down to that level. Let's take a look at NASDAQ before we wrap up the stream. Let me know one big takeaway that you guys had before we hop off. You guys just spent, I don't know, an hour and a half watching this stream. This ain't Logan Paul. This ain't freaking, whatever else everybody's watching. This is a live trading stream. It's a chart addict stream. So let me know before you guys head off, just so we can at least learn something today. Give me one key takeaway, whether it be trading related, fundamentals, news-wise, patience. Give me one thing before you guys hop off, and drop a like on your way out. Appreciate everybody for hopping on. While you guys are typing that out, just a reminder, if you guys want to learn this NAS 100 day trading strategy that we trade live every single morning, all the evidence is there on YouTube for this trading strategy. Head over to the link in the description for NAS 100 Masterclass starting February 2nd. That's this Friday. It's a 3-day online masterclass with an extra bonus day for Q&A. Register for your seat. This is the last masterclass we will ever do teaching this NAS 100 strategy. Highly recommend you guys register before the time is up. We are in profits on the NASDAQ trade. So what I'm going to do is move my stop loss to break even and protect this trade in case sellers want to step back in. Oh, cancel. It might be a little premature to move stops to break even, but this is just one of those trades. It's a news day. I'm not here to be a hero. If this thing continues to reject the upside and fills this top wick, perfect. If it doesn't, there's always going to be opportunities tomorrow. And so I'm not pressed about catching this trade. All right. Definitely learn patience, take partials, how calm and collective you are when in major profit. Yeah, brother, I'm on a live stream with a ton of folks, all eyes on me and money on the line. You got to detach. You can't think too much about, oh, I got money on the line in this account and that account. You have to take it trade by trade. You got to get locked in. And then afterwards, you go back and review and be like, well, what just happened here? And I think that's the best way to do it. You got to be fully present. Trading is truly against you. All those inner thoughts you have to fight against or agree with while in a trade or before and entering and exiting. Yeah, I mean, trading is a psychology game. The people who set up these markets understand human psychology. The people who can capitalize on markets understand human psychology even better. So knowing yourself is the best way to understand human psychology. Like if you know thyself, that ancient cliche, know thyself and you will know others. And so if you want to understand market psychology and market mechanics, you have to understand yourself first. How are you reacting? Why are you reacting a certain way? What emotional response is the market trying to drive out of you? What is the immediate response you had? How can you fight that? And really having that full understanding of human nature will allow you to be very effective on the charts. Wait for a retracement to the discounted price. I'd love to see it. Thanks for bringing Ken on. Please try to get him on FOMC days. Will do. Bob Elliott was supposed to get on, but he's at a hedge fund conference here in Miami. Was he more hawkish or dovish? I would say he was more hawkish, only because he said very clearly no rate cuts in March. So we might even see a little bit of a sell-off, and then eventually, like in the next 2 weeks, we'll see a bullish rebound. This is still bullish. We're still at the end of the tightening cycle. But the timeline of when we can expect all that to happen, that's what everybody was waiting for. It seems like Jerome Powell did not want to put a number on it, and it seems like March is definitely not it. So that's the clarity that we've gotten so far. I learned patience is vital for success. Yeah, it is. And emotional control is too. I learned that the best scenario is valid as long as you follow your plan. There we go. I told you before the 4-hour 2 EMA was gonna come and get tested. Brother, I believe you, but at the same time, I'm still making money. So like, it is what it is. I hit you guys up for free tickets to the summit and no response. Well, that's not good. Send us one more email, a reminder email. We've been very busy with the FX summit, so cut us a little bit of slack, but we guarantee we got you. If you guys have already taken the NAS 100 Masterclass, you're not in the VIP chat, you guys can get access to the next NAS 100 Masterclass for a discount. So if you guys want a $100 seat to the next NAS 100 Masterclass, just to get a refresher, I recommend you guys reach out to us as soon as possible to take advantage of that opportunity. If you're in the VIP chat, you guys will get free access to the NAS 100 Masterclass. So appreciate everybody in the VIP. All of you guys on YouTube, drop a like on the way out. Appreciate all the participation today. Happy and safe trading. See you tomorrow bright and early for a New York Market Open stream. Take it easy. It's your host, Roy Jr. for Chart Addicts. Peace.